Despite all the global trade drama and stock markets throwing a tantrum over Trump's new Liberation Day tariffs, the International Monetary Fund has said that there is not a global recession on the horizon. My name is Jack Rivers and welcome to this week's episode of Tax Tidbits, where trade uncertainty is definitely off the charts and global trust is crumbling faster than a soggy biscuit. But the world economy isn't going off a cliff just yet. This week, the IMF projected slower economic growth rather than an outright downturn, which is, I think, the best we can hope for. Funnily enough, they predicted that US growth would be impacted the most, now expected to be 1.8% this year, down from 2.7% predicted in January. The forecast contrasts with more pessimistic views from other organisations like the World Trade Organization, the Bank of England and the European Central Bank, all of which highlighted risks to global growth. All this means for now is that businesses need to buckle up for a bit of a bumpy ride, but luckily not a crash. So don't panic, but definitely review your export strategy. Speaking of the IMF, they have also predicted that the Bank of England could cut interest rates 3 more times this year, despite their forecast that the UK is facing the highest inflation rate among advanced countries, forecast to be 3.1% this year. Why blame those ever-rising energy costs and water bills? Despite that, the IMF says inflation is just having a moment and should come down to a more polite 2.2% by 2026. Growth-wise, the UK economy's had a bit of a downgrade, now expected to grow just 1.1% in 2025. Still, we're apparently doing better than France, Germany and Italy, so small wins. In an aim to improve growth forecast, Chancellor Rachel Reeves is off to Washington this week to try and charm the US into a trade deal that could stop British exports from getting smacked with hefty tariffs. All of this could mean there is slightly cheaper borrowing in our futures, but with inflation and tariffs still making life interesting, it's not quite time to pop the champagne just yet. Speaking of tariffs, because you can't just avoid them in the financial news at the moment, DHL is putting the brakes on shipping anything over £600 to the US thanks to a mountain of new customs red tape triggered by the tariffs. The delivery giant says it's overwhelmed by the surge in paperwork now required for high-value items and will halt these shipments until further notice. Business-to-business deliveries will still go through, but delays are expected. Previously, items under $2,500 breezed through customs, but the threshold has been slashed and things are only set to get messier. From May 2nd, the US will also shut down a loophole that let low-value packages, mostly from China and Hong Kong, avoid duties, hitting budget retailers like Shein and Temu, who've already warned prices will go up, which means your £4 hoodie might start costing £6. It's all part of the US effort to crack down on dodgy shipments and tackle the opioid crisis. But for global e-commerce businesses, it's turning deliveries into a bureaucratic obstacle course, with customs forms instead of medals. For UK businesses, expect delays, cranky customers, and a possible spike in local interest. The UK government's been flashing the plastic a bit too much this year, racking up £151.9 billion in borrowing, £20.7 billion more than last year and well over what was forecast. Why? Mostly thanks to bigger spending on pay and benefits to keep up with inflation. Despite a nice boost in tax income, the government's outgoings ballooned, leaving debt levels not seen since the Beatles were topping the charts. Chancellor Rachel Reeves insists the government's not going rogue with public finances, but with talk of possible tax rises or spending cuts in the autumn budget, businesses might want to start prepping for tighter times. After years of waiting, HMRC has finally enabled multi-agent access for Making Tax Digital for income tax. So now your accountant and bookkeeper can tag team your tax returns without stepping on each other's toes, hopefully. The new rules make it clear that the main agent, usually your accountant, handles the big stuff like finalising returns, while the supporting agent can help with the quarterly updates. Just don't mix up who's who, or someone might lose access and not find out until they're locked out like an ex on Netflix. It's a long-awaited win for time-strapped agents and a game changer for compliance, though there are still quirks and caveats to watch for. For UK businesses, this should streamline digital tax reporting, less faffing around, more focus on running the actual business. And that's a wrap for today. Don't forget to hit that like button if you found this useful or if you just want to make my day. And as always, subscribe for more updates. Catch you next time.